is John Rubino from DollarCollapse.com, and you're listening to Run to Gold.
Welcome back to the 88th episode of the RunToGold.com podcast. And in this episode, I'd like to talk a little bit about the gold and silver markets and how they relate to this latest video from Eric DeCarbonal of MarketSkeptics.com. With the gold and silver markets, of course, gold has hit $1,500 an ounce, and silver has hit over $44 an ounce. Record prices, of course, when priced in fiat currency. However, as I wrote in my article about Mark Faber's comment that gold is cheaper now than it was in 1999, I actually think that there might be some truth to that. Silver is still in sustained backwardation, but it's not backwardated across the entire futures curve like it had been. In this case, currently it's only in backwardation from May of 2012 to December of 2014. One of the theses behind this is that there's going to be additional silver supply coming online from various mines that are going to be delivered around those dates, and because of that, that's why the price is going to go down. Increased supply, demand remains the same, price should go down. I think we're going to continue to see investment demand for silver, and particularly because of all the counterparty risk and the interest rate risk, which is kind of the main component of these derivatives that are failing, these financial weapons of mass destruction. Now, when getting to these derivatives, the whole reason we need derivatives and the whole reason we need almost all the financial instruments that we have in today's day and age is because we have the Federal Reserve and we have fiat currency and fractional reserve banking. Now, what the Federal Reserve has been doing to maintain confidence in its little colored coupons that aren't actually anything tangible, as Eric DeCarbonal elucidates in his video, they've been selling puts on long-term treasuries. Now, this is actually just kind of really crazy because it's like buying insurance from an insurance company for that insurance company. So, I mean, when you buy insurance, like if you go to Geico and buy insurance for your car and you wreck your car, then you get to put your car to Geico for the value of the car before it got wrecked, right? Well, would you buy insurance on Geico from Geico? I mean, that doesn't make any sense because when Geico wrecks and isn't worth anything, how are they going to pay you what they were worth before they got wrecked? This is effectively what the Federal Reserve is doing by selling puts on the long-term treasuries. Here are a couple quotes from actual FOMC meeting minutes and various documents straight from the Fed, which Eric DeCarbonal links to very thoroughly in his blog post on this issue. One of them is a quote, "Of course, a successful program would be one which any option sold would never be exercised," end quote. This shows kind of the intent behind the program. They don't intend to pay out on these options to begin with, because that means that the insurance company would be wrecked, right? Another quote, "We could sell put options on long-term treasury securities at strike prices associated with desired longer-term yields." Okay, you couple this with another quote, "Third, a large volume of options sold could reduce risk premiums embedded in longer-term rates, independent of the level of credibility about any policy commitment," end of quote. So what we have here is when you're making a market, the prices are set at the margin, depending on whatever the bid and ask are and the spread between those two. This is one of the reasons why I think there's so much value to be had in private deals right now, because there's not a lot of competition, the liquidity's dried up, and so you can really come in with the low bid and somebody might hit, or you might be able to hit an offer that's low and pick up a lot of intrinsic value. And so when we're dealing with the larger public markets, and you have this, quote, large volume of options sold, end of quote, that you're using to reduce the premiums, you're only dealing with, that 1 or 2% of the supply and demand that's at the margins of whatever particular market you're dealing with. And so if you sell enough of it, you can move the price wherever you want to. If somebody comes in and sells gold at a severely undervalued price at, say, $5, but they've got like 100 bajillion ounces of it, then it's going to drive the price down to $5 until that seller either runs out of supply or no longer offers at whatever price. And so, even if you want to buy all bajillion ounces at $5, you still have to have the $5 to buy it. And so as that pricing is going on in the market, it's when an institution or organization is able to step in and overwhelm the offer depth of the pool because they can sell, in effect, an unlimited number of these put options, then you're able to control the price through this manipulation. Of course, that's in the short term, but with governments, their short term might be years or a couple decades, as opposed to an individual's long term, short term, which is a couple days, weeks, or months, at the most. Now, another quote, the most cost-effective way to protect against a sharp rise in nominal interest rates is, therefore, to buy put options on those bonds, ends of quote. Now, I was talking with a friend of mine he's a broker-dealer, works for a broker-dealer, and we'd been talking about peak oil, and this was like clear back, 4 years ago or so, and I made a comment to him, which I think is very applicable to the discussion here. I said, the derivative controls the price of the underlying. Now, what I mean by that is, it's kind of like the tail wagging the dog. If you can control the derivative, then you're going to be able to control the price of the underlying because there's not going to be necessarily like the arbitrage opportunities and whatnot in there. And so if you come in and you overwhelm the put options, then people are not going to buy too much of the underlying. They're going to buy what they need, and when you're dealing with things that aren't necessarily hoarded like oil but consumed, then it's going to be able to keep that price down. Now with treasuries, this has a very interesting dynamic in the Great Credit Contraction because this same friend of mine, he was asking me, when's the dollar going to collapse, and become worthless through hyperinflation? And I was like, well, it's going to be the last one standing out of all the currencies. He's like, really? I was like, yeah, I've written about that a lot. That's why it's, the bottom layer of the liquidity pyramid right above gold. Because of the depth of the capital markets, our securities, and commodities markets, the dollar's just got such depth to it, which is where this large volume of options comes into play. We're a $14 trillion economy, and so the dollar, the only real threat, to this monopoly is the euro, and then you got the yen and the pound, but they're not deep enough to handle these big capital flows. And so the only real competitor to these fiat paper franchises is gold. Ultimately, all of these fiat currencies are the dollar, and they're all going to evaporate before the dollar does. And this is exactly what we've been seeing, and why the other central banks and governments are being engaged in competitive devaluations and things like that. Well, in this whole process of the Fed selling these puts, in effect, they're trying to effect a price control on the Treasury securities. And the consequence from that they don't intend to bear. They never intend to pay out on these options that they're selling. In fact, they said so. A successful program would be one which any option sold would never be exercised. That's because they don't want their little fiat paper franchise to go away. So they're able to sell these puts to keep the interest rates low. And they don't really have to worry too much about the real long-term consequences, because the long-term consequences are that the Fed's going to go away. And it's just a matter of time. Now, there's going to be a lot of rearranging of the chairs and the wealth in the meantime when that happens. But when you're dealing with these long-term rates, and you're dealing with the large capital flows, and this all relates to China, because as we sell these put options, then the principal value of their treasury securities maintains its value. And so they use that to go in and, they're buying companies and countries. They're very active in Africa, which I actually think there's a lot of opportunity in Africa. I think that we're going to see a ton of opportunity over the next 20 years to invest in Africa. Now might even be a good time to buy some real estate over there. I'm not personally going to buy any, but because I'll just pick it up later when it's cheaper in terms of gold and there's a little bit less political risk. But if you're a little bit larger, longer-term strategy like China, then that's what makes sense, because with the market you don't have enough volume to really meet your demand when you go to sell treasuries or things like that. So China's kind of screwed with this because they own so many of our treasuries. But if they're able to have the Fed sell these put options to keep the interest rates low, because if the interest rates rise, then you're going to take a massive hit on your bonds based on the principal, because of the discounted future cash flow and the net present value and the discount rate. So this is, this kind of ties in all geopolitically, and it very well could be a reason why China is trying to keep Europe afloat. China is lending money to Spain and just Portugal, and trying to keep that sovereign debt crisis from really exploding and having the contagion. And so the Fed, they're using these put options to keep the interest rates of the treasuries low, which helps to maintain confidence in the dollar. And of course we know that gold is the antithesis of that. So as long as they're able to manipulate the price of the treasuries through the derivative put options, then they're able to influence market perceptions and the price of gold. Well, what that does is because the price of gold is lower than it otherwise would be, it increases demand. And so, because it's cheap, why not buy it? As Mark Faber is saying, it's cheaper than it was in 1999. Well, it might be actually a lot cheaper because of how many of these put options the Fed's been selling in the last 10 years. And we haven't really seen any substantial amount of capital move into the gold market yet. Bloomberg just reported about the Texas Retirement Fund that just moved $1 billion into physical gold and took physical delivery of it. And look at what's happened to the gold price since they probably started taking delivery. It's probably at $50 an ounce just from them taking the physical metal. Well, that's what's going to happen when you set these price controls through these put options and through, because this is really just another extension of the gold price suppression scheme, a very clever one. Is the price gets too low. And so eventually there's going to be a shortage. Shortage will lead to rationing. But the whole system's just going to go boom. And that's what I think this sustained silver backwardation that I led into this podcast, that's what I think this is about, is the dollar there's a run on it. The Texas Pension Fund is the first of these kind of whales to move, and say, I need gold. There was Northwestern Insurance. They took $400 million of gold. And then you had Einhorn, and he converted his GLD position to gold after I wrote my article. He did that about 6 months later, and it's kind of funny. And so I think that we're going to be seeing even more demand for the monetary metals. Even though they're at record highs, I don't think that they're at record highs in terms of value. And I think that the more people, the more they're in the consciousness hitting all-time record highs, the more people realize that there's something seriously wrong with the fundamentals of the currency. And that's when they begin searching for alternatives and searching for different ways to employ their gold, through hypothecation and through, perhaps there could be a way to trade stocks and settle in gold instead of these fiat currencies. Maybe we could have a stock exchange that settles in gold. That would be pretty cool. It'd remove a lot of costs from the current stock exchanges we have. But that highlights that the demand for gold is so minuscule. I mean, we don't use gold to settle any oil contracts or any wheat contracts, or to, nobody uses it as a currency in their ordinary daily transaction. People barely own any of it. Look at the pension fund. They bought $1 billion worth, and they're just making waves. $1 billion worth? How much have they pumped into the system in the last few years? $50 trillion? So when you use gold as your numeraire to keep your balance sheets, and you're looking at this wealth destruction that's going on, and that's really what bear markets do. Bear markets destroy wealth. They destroy illusory wealth. The politicians who go out and engage in war, they're the ones engaging, destroying the real wealth, because they borrow money to blow stuff up. And so not only do you destroy the capital asset, but you have a debt remaining, and you have nothing that you bought with that debt because you blew something up with it. So, I mean, they're the ones destroying the wealth. And that's what bear markets do. They destroy the illusory wealth. And so if you denominate your net worth and things in gold, ounces, then this $1,500 an ounce is just shredding your portfolios. And I was talking with a couple of friends of mine. We were having dinner, about a 4-hour dinner. And the people at this dinner, they're all net worth of 9 figures, at least $100 million or more net worth. And so we're talking about just this massive mess. And one of the guys, he managed money for George Soros, which is kind of fun, right? And I was talking about interest rates and this gold price suppression scheme, and I hadn't really heard about these put options on treasuries yet. But I said, interest rates, they really have to go a lot higher to compensate for the risk that's in the market. And he was like, well, how high do you think they'd have to go? And I was like, well, 50% at least. And he was like, okay, I'll give you 50%. And I thought that was really interesting. I kind of pull a number that I've kind of been looking at it. Hey, when will I sell my gold? Probably 50%, because nominal real rates, we've got just this massive mess. I don't want to sell my gold and hold on to fiat currency that's being fractional reserve banked, but I'd do it if I thought the risk reward aspect of it was good enough. But to think that 50% interest when we're currently at like 0.25%, what would that do to the economy? Student loans and housing. What if you went to go get a mortgage and it was 55%? But that's what we're looking at, because they've been selling this large volume of options to keep the price of treasuries down, to keep the yields low and things like that. So, I mean, I think we have severely higher interest rates coming, and people who are managing money, they're starting to wake up to the fact that there is a lot of risk out there, and they're starting to wake up to the fact that treasuries are not risk-free. In fact, they're a form of return-free risk. And that's going to be a serious problem, because there's just not the volume there in other assets for all of that illusionary crap to go into. And so it's going to have to be destroyed. It's going to, system's not going to collapse, it's going to evaporate. And poof goes all these pension funds and things like that. And the irony is that the Fed, in these Fed documents, they actually even see this happening. This is a direct quote from them. Quote, "The resulting rush to unwind market positions would likely be very disruptive and send yields sharply higher." End of quote. And so that's exactly what I think we're going to see. They've been selling these puts to keep the yields down, keep treasuries up in the long term. They're trying to manipulate the curve. China is waking up to the game. They're shortening the maturity curve of the stuff that they hold. People are moving into shorter and shorter term maturities. You look at Greece, their 2-year yields are just broached 20%, while their 13-month money is costing like 4.1%. So people are moving closer and closer in, and then ultimately closer and closer into just the fiat currency instead of like a 3-month or 1-month treasury. They're moving straight into getting closer to Federal Reserve notes. And then once they get there, then the only place to go is gold and silver and platinum and palladium and things like that. And that's where we're going to go. And it's going to be very disruptive. And it's going to send yields sharply higher, just like they said. Because, someone wanted to borrow some money from me about 1.5 years ago, and I was like, well, if I'm going to lend you money, we're going to tie it to gold. And they didn't want to tie it to gold, so I didn't lend them any money. But what happens if they borrow 100 ounces of gold, and then the price of gold goes from like $1,100 to $1,400? Well, that effective burden is still going to be on them, as opposed to not having the effective burden on them, which is what has been happening slowly. But so holders of capital and savers, they're not going to lend their gold out for these paltry interest rates that current holders of capital are lending out at. And so we're going to have some big disruptions in the bond market because interest rates are going to be going higher, not lower. And people are going to be moving out of fiat currency, not into it. And this is all a result of the gold suppression scheme ending. And it's ending because people are saying, give me physical delivery of my metal, and it's sending the metals into backwardation. So anyways, this has been the 88th episode of the RunToGold.com podcast. I hope you found this elaboration on Eric DeCarbonall's great video helpful and useful, and talk to you later.
This is Tom DiLorenzo from the Mises Institute, and you're listening to Run to Gold.